Good afternoon, ladies and gentlemen, and welcome to the Munro Partners Climate Change Leaders presentation. My name's Steve Fletcher, and on behalf of all the team at GSFM, the distribution team, and also Munro Partners, thanks very much for taking the time to tune into the webinar today. I'm joined by Munro Partners co-founder and CIO Nick Griffin, along with portfolio manager James Sanitas. Welcome, guys. Great to have you on the call.
Thanks for having us, Sledge. Good to see you.
Thanks, Steve.
The call will run for approximately 25 minutes, followed by your questions, which you can submit through this session at any time. Now, also joining us for question time is Mike Harut. Mike is Munro's responsible investment manager. Mike joined Munro quite recently from the ASCI, which is the Australian Council of Superannuation Investors. And prior to that, Mike worked at the Future Fund as an analyst working on ESG. So Mike is here to assist you with all of your ESG questions later on in the session. Now, the topic for discussion today is the Munro Climate Change Leaders Fund. As lead portfolio managers of the Climate Fund, Nick and James are focused on creating a portfolio of climate winners that help enable the decarbonisation of the planet. For Munro, they believe one of the biggest and best things you can do when investing is to find structural tailwinds. And Munro would argue today the biggest structural change that we are likely to see in the coming decades is in fact climate change, quite possibly the biggest opportunity since the internet. So to understand more about this structural change and the tailwind that it's providing investors, I'd now like to hand you over to Nick and James. Over to you guys, thanks.
Yeah, thanks very much, Steve, and thank you very much everyone for dialing in and just echo those sentiments. So obviously, look, it's a bit of a difficult time in the world right now. It's a difficult time if you're in Sydney and Queensland with rain, and it's a difficult time if you're in Eastern Europe. And you know, our thoughts are with those people. But ultimately today, the message we're going to be sending is unambiguously positive around the enablisation or the decarbonisation of the planet. And so hopefully when we get to the end of this presentation, you'll see that as much as these things are very difficult right now, and they are difficult, they do actually accelerate the opportunity that we're going to talk to you about today. And hopefully when we get to the end, you'll agree. So today we're literally just going to be talking about the Climate Leaders Fund. So it's going to be very much focused on this new product we've launched. I will just very quickly introduce the business very quickly for anyone who's new, who is on the call. We are a global growth manager. The business was set up in 2016 to be your global growth manager. We do that predominantly with our global growth funds today, but we are now today also talking about our new Climate Leaders Fund. The business is, of course, a partnership. So we do have continued to invest in our business over the last 5 to 6 years that it's been running. We do own and control 75% of our business, and there are 9 people on those page who are partners in Munro Partners. And our goal is to continue to add great people like Mike to the team and continue to evolve them into the partnership to basically ensure our long-term goals are achieved. I'm just going to make one comment about investment process before we dive into the product. I just want to be really clear that we are a growth manager. We do believe that earnings growth drives stock prices. So generally, you know, we're generally looking for companies that can grow their earnings sustainably over a long period of time. We generally think the market will misprice that growth, and that ultimately share prices will follow earnings in the long run. I show these 2 companies at the start of every presentation now for nearly 6 years. One is MasterCard, one is Bank of America. Our view, our goal, and what people look at our products for is to identify these big structural changes and to identify these big structural winners. We generally try to ignore these macroeconomic stocks, you know, going over or underweight different sectors. We don't think it's really how you're going to access returns. And so it is this structural change that we're looking for. And today we're clearly talking about that structural change within climate. And so maybe just to take a step back here, you know, we've been running this process now as a team for over 15 years, 10 years at our previous firm and more than 5 years here now at Munro. And the process is very, very simple. The process is designed to look at the global equity universe and realize that there's just thousands of companies there, and you have no hope of covering them all. There's usually a whole bunch that profess to grow, but they're always growing like that Bank of America or you know, some other companies where there's no, they're just macroeconomic companies. There's no structural tailwind, as Steve was talking about at the start. And what we try to focus on is this structurally growing universe, these companies that can grow structurally through time. There's always some big structural tailwind behind them. And that tailwind ultimately leads, if the companies position themselves right, to earnings growth, and that earnings growth ultimately positions itself to share price growth. This is what we've been doing for 15 years. And you've probably heard us talk a lot about things like high performance computing, which is semiconductors, or digital enterprise, which is cloud computing, or innovative health, or e-commerce, and these are our big and very public support of companies like Amazon a long time ago, or companies like ASML in semiconductors, or ServiceNow and Microsoft in software. And so what we're talking about today is just climate. And so we've actually been looking at the climate AOI since 2005. So it's been in our universe for more than 17 years now. We've had these companies that we look at them. And what we're generally saying today is that we're just going to focus on this one specific area of interest, because we have decided to launch a standalone product or a satellite product that will just invest in our climate AOI, just invest in our best climate ideas. And maybe just to kick it off, why did we choose climate for our first one? And I think it's very important to stress this. This is very much a thematic fund. We will talk about ESG, but when we talk about ESG, what we do across all our funds, what we're saying here is it's a thematic fund for climate. And the reason why we chose climate first is because, honestly, if we could go back to 2005 and start an internet fund today, back then, we would have. All the work we did around digitalization, all the work we did to understand e-commerce, cloud computing, digital advertising, semiconductors, all of it basically played out over a 15 to 16 year period, and effectively drove those double-digit returns that we've managed to achieve for our clients for 15 years. And a lot of that's sort of happened now, or at least halfway through. The reason why we chose climate as our first one, not because we think it's the topic du jour, because this one's right at the start. It's right at the start. We know these companies well. The work we do here will be the start of the biggest S-curve that we think for the next 30 years. And so it's obviously the biggest opportunity now today to look on a 10-year time horizon and invest here. And in the next few slides, I'll show you why. So let's fairly quickly talk about the product. So as you know, we have our absolute return products, which is our long short absolute return global growth product. It has 30 to 50 positions in it. It does run at a lower beta than the market most of the time, and it's listed on the Australian Stock Exchange under the code MAET. And so that's our Munro Global Growth Fund. It's probably the product that we're most well known for today. Important to stress, we do have a long only version of the same product, which is the same 30 to 50 global growth ideas. So it includes, semiconductors, cloud, and climate ideas in both of these products. And that's listed on the stock exchange under the code MCGG. And the product we're going to talk about today is this satellite, or this step out product, or this thematic only product, depending on which way you want to think about it, which is just going to be 15 to 25 ideas that we think will help enable the decarbonisation of the planet. It's important to stress it will be fully invested at all times. So it is a long only product. It's not a long short product. It's important to stress that it's growth and it's highly index unaware. And it's going to run at a beta higher than the market. So it is going to be quite volatile. It's not going to be as diversified as, say, a global equity product would be. And it's listed on the Australian Stock Exchange under the code MCCL. And so from our point of view, this product, we think, is designed to actively outperform the ETFs in the marketplace. There are ETFs in the marketplace. They generally have 60 to 100 names in them. Our view is with our concentrated stock picking process of 15 to 25 ideas, it's a better way to capture this opportunity. And the last thing we'd say about this product is you should think about it as a satellite product or a step out product, because if you too believe that this is the next big opportunity in the world, or secondly, if you want to allocate dollars to here because you want to help enable the decarbonisation of the planet faster. Okay, so that's the products and that's how they exist, and happy to go back to that in the Q&A. So the Climate Change Leaders Fund, this 15 to 25 stocks is going to be a portfolio of structural climate winners that help enable the decarbonisation of the planet. That's the key word, enable. So it's not the best ESG companies in the world, it's the companies that will benefit from this trend. And why do we think this trend is happening? We think this trend is happening because it is abundantly clear now that the world is not doing enough to stop temperatures rising by more than 1.5 degrees. And so the Paris Agreement and SENS are all focused around this, let's keep the temperature rise to less than 1.5 degrees. This is what you have to do to CO2 emissions to make that happen. It's going to cost a lot of money. We know it's going to cost a lot of money to get to net zero by 2050. But what's becoming more and more apparent is the cost of not getting there is actually going to be more. These climate problems that the world is having are going to keep coming. Every single Royal Commission in Australia has pointed this out. And so we got to ask ourselves, what are we going to do to prepare for this? What are we going to do to stop this from happening? We need to accelerate the decarbonisation of the planet. This message is getting through loud and clear. And I think the big tipping point for us that happened in sort of 2018, 2019 was just seeing the corporate world get on board. And so previously, when we looked at the climate area of interest, it was always country targets that you were focused on. You know, would this certain country bring in a carbon mechanism? Would a country bring in certain subsidies? And the stocks would be very volatile around that. What we're seeing now is that investors are effectively demanding that corporates decarbonise. It's part of their ESG initiatives. And we're seeing every corporate in the world effectively set a net zero target by 2050. And what that means is it becomes inevitable that we're going to spend money to try and do this. The simple way to think about this is BHP has a sustainability report here in Australia. It's audited by EY. It's over 100 pages long. And in there, they basically set out a plan as to how they plan to hit their net zero target and the dollars they're going to have to spend to do it. And so what we think is that means that the world inevitably will set a task of decarbonising by 2050. Will it get there by 2050? We don't know. But what it means is you're at the start of this huge S-curve of opportunity to help decarbonise. And so from our point of view, we've seen a lot of numbers out there as to how much this is going to cost. We've seen a lot of estimates from different places. The answer is, I think, and most people on this call will agree, it's a big number. We're saying it costs roughly $50 trillion over 30 years. I've seen numbers as high as 100 trillion. But it's important to stress that that $50 trillion that you're going to have to spend to decarbonise the planet, i.e. BHP has to spend to reduce emissions in its buildings or to reduce emissions on its mine sites, is going to be split amongst a very broad range of areas. And it's important to stress that these areas are quite wide and quite diverse. And I'm going to let James tell you how we extend to capture this opportunity. But before I let James just step in here, I just say the one thing you should think about here is if that's $50 trillion to decarbonise the planet, then that's 50 trillion of revenue to the companies that's going to enable that decarbonisation. And so that's how we've thought about it when we build this product. And I'll let James talk about how we've broken down the opportunity.
Great, thanks, Nick. Thanks everyone for your time today. So this is how we're thinking about the opportunity of when that $50 trillion of revenue opportunity is going to be spent. This is actually some estimates from the European Investment Bank that they put out a couple of years ago of where they think the money will be directed. And this might actually move in Europe. For those that have been obviously following, Europe's going to try to move themselves off fossil fuels much quicker now that the situation with Russia has occurred. And so these splits might well change and the numbers actually might get bigger, as Nick's sort of flagging. But as at a couple of years ago, their expectations were about a quarter of the money was going to be spent on energy efficiency. So that's retrofitting old buildings with new heating and cooling and insulation and so forth. About 20% was going to be spent on renewables. So that's building wind, solar, batteries, etc., to basically move off coal and gas. Another sort of 20% or so spent on passenger EV, 10% on batteries there, hydrogen, transmission grids, etc., etc. So that was a rough spend of where they expected the money to be spent. And this is basically the starting point of our process in terms of looking for the companies set to benefit. So if we go to the next page, we've just got a sort of stylized version of that, of how we've basically segregated our universe and how we're thinking about the opportunity and the companies that are going to benefit. So the top left-hand corner is the clean energy companies. So that's that 20% or 18% to go to renewables. And this includes companies that build wind turbines, make solar panels, etc. But it's also the companies that develop those assets. So it's companies like NextEra, which is the biggest utility in the US, but also the largest developer of solar and wind in the world today. Top right-hand corner is these energy efficiency companies. So these are the companies that are involved in retrofitting the buildings and homes and so forth, putting in insulation that reduces the required heating amounts. Companies like Kingspan that we've followed for a very long period of time, which is an Irish insulation business. Company like Train Technologies that does heating and cooling equipment. Companies like Schneider that does smart sort of electronics, sensors around lighting and so forth. Bottom right-hand corner is the clean transport side. This is probably the one that gets the most attention at the moment, or has been getting the most attention. So here sits Tesla, but also its supply chain. So companies involved in the semiconductor side, power semiconductor side to basically make the car go. It's companies like onsemi, companies involved in the battery. So that's Samsung SDI, which is a separately listed Korean company. Companies like Albemarle, which is commodities as well. Bottom left-hand corner here is a bit of a mix of ideas, but this is circular economy. So this is companies involved in basically reusing what we have today, the natural resources that we have today, because we do live in a scarce world and a world of scarcity. And so this is companies involved in collecting trash and recycling it, or collecting food waste and using it to produce biofuels. Companies involved in collecting plastic bottles and basically recycling the plastic. Companies involved in a substrate shift as well. So companies involved in basically reducing the world of plastic and maybe moving to aluminium cans in the case of Ball Corp there down the bottom. So that's sort of the universe. The fund doesn't invest in all of these stocks, but this is basically a flavour of the approximately 100 or so companies that we have in our universe across these four sub-segments. And so if we go to the next page, please, Nick. This is just the fund as it sits today by those four sub-segments, then the number of positions, and then an indicative position on the right-hand side here. And so you'll see here, the clean transport and energy efficiency is a smaller part of the fund today than perhaps what we envisaged a couple of months ago. And that's because these two segments are a little bit higher beta and a little bit higher valuation. So some of the clean transport stocks are quite expensive because they've been basically bid up by the market. Not all of them, but some of them. And so we have reduced that area coming out of last year and into this year as we expected the markets to become more difficult. The energy efficiency names, as I sort of mentioned, they're more involved in sort of renovation cycles and so forth. So they can be a little more cyclical as well. So we're just managing the exposure there as well to those two subsegments. We have pushed more exposure into the circular economy side, which involves a lot of packaging stocks, which tend to be very defensive in nature. And Ball Corp's an example there is a company with sort of a third of the aluminium cans market share in the world, and obviously taking share from plastic bottles and so forth. So they tend to be a little more defensive, and so we've shifted a bit of exposure there. And then the second one there is the clean energy side. So here sits the sort of renewables developers that I was talking about. And the example there is NextEra Energy. So a bit more exposure to those two subsegments than we'd normally expect. Over time, we would expect to capture all of the opportunities, but at the moment we're just a little more, I suppose, weighted to those more defensive areas as we've sought to sort of lift the average market cap of the fund, lower the average valuation multiple of the fund, and also lower the beta as well of the fund as well. So that's why the portfolio is a little more tilted at the moment, as we show there. On the next slide here, please, Nick. We've got, just to give you a bit further flavour. So we obviously think about it in terms of those sub-AOIs within climate and the opportunities on the stock-specific basis. But just for those that are interested, on the left-hand side here, we just show the regional exposure. So unlike our other funds, which tend to have a lot more US because there's a lot more tech and healthcare and the like in them, this one has a bit more exposure to Europe, and we'll probably talk a little bit more about some of the bottom-up opportunities, but probably no surprise to people that Europe's leading the charge here on the renewables side. On the climate side, and so that's why we have a little bit more exposure there to Europe than the other funds. On the right-hand side, we just show the sector exposure down the bottom. Again, the other funds tend to have more exposure to sort of tech, etc. Because we're investing in a portfolio of companies that enable the decarbonisation of the planet, as Nick said, you end up in more companies that are actually building things and making things. So that leads you to more industrial type of companies, utilities and materials, and less so tech. So just wanted to flag that on a sector basis. And then you see the top 5 holdings at the top there as well. So we can talk about some of those if people are interested. I might just flick forward here and just dive a little bit more into the clean energy side, and Nick will go into the clean transport as well, just to give some flavour on some of those sub-segments. So first one here, clean energy. So the first thing just to point out here is that electricity needs to take share from fossil fuels. So at the moment, electricity is only 20% share of, or 20% share of power consumption in the world, and there's still a very large footprint in oil, gas, coal, etc. That electricity piece needs to take a lot more share. It needs to go to 50% at least, and renewables need to take share within that. And so that's the first thing to point out. And what's that going to lead to? It's going to lead to a build out of renewables quite quickly, which is on the next slide. Here, and so we expect actually 20x growth of renewables here, as we show here on the left-hand side of the slide here, and that's going to be made up of a mix of onshore wind development, offshore wind development, but also solar as well, and some other power sources as well there. And the company's set to benefit of those at the bottom there. So that's again a mix of these traditional utilities that are developing these assets, and some of the wind OEMs, those that make the turbines, and the solar guys as well. Why is this going to occur? Well, we need to decarbonise to avert the 3 degree, I suppose, and get back on that 1.5 degree trajectory. But it's also going to occur for economic reasons as well, because it's just actually makes economic sense. And that's on the right-hand side here of the slide. And you can see the cost of solar and wind is actually below the cost of gas and coal. And this is actually a dated slide. Obviously, if you look at this today with what's happened in fossil fuel markets, in gas particularly, those prices have spiked. So it makes more sense now than ever to basically transition. On the next slide here, I'll just quickly run through a stock example. And this is NextEra, as I already flagged. And so those that have watched our webinars before will be aware of the 5 tests that we run at Munro on the left-hand side here. So this company scores well for growth and economic leverage, i.e. it's EPS growth, it's sales and EPS growth. So it's doing about a 10% growth per annum rate. The sustainability of that growth of 10% growth is very strong. It scores 5 out of 5 there because this is a long-term tailwind. We talked about 30 years to decarbonise the planet. It's not happening this year and then not the next year and then happening the year after. It's going to be a solid trajectory of that or sustained trajectory of that 10% growth rate. The company doesn't quite score as well on the control score as other companies in our universe because it's not a founder-led company at the moment, but nonetheless strong incentives and so forth for management to basically invest for the future. And that's what the management has a good track record of doing. Last point there is customer perception. Scores very well there because it's got good reliability, produces clean energy, and therefore has a strong customer perception and also good value as well in terms of bills. So all up, this leads us to pay a high teens EV to EBITDA multiple for the stock. So it's not a cheap stock relative to the market, but still pretty decent relative to the company's sustainable growth rate of that 10% earnings CAGR for a very long period of time. So that's just a quick run through of a key stock in the clean energy side. I'll pass back to Nick for the clean transport.
Yeah, and so I'll just quickly run through some of our clean transport ideas, and then we'll throw it out to I'm sure your lots of questions. So when we think about clean transport, and again, this is the exciting S-curve opportunity that's occurring here, and so many people would have seen us talk about the smartphone transition. That mobile phones don't grow, but smartphones went from 10% to 80%, and that ultimately created Apple, which is the biggest company in the world today. Cars are going through the same transition. So this is global car production globally. Today, it's roughly 90 million cars per annum. It's probably not going to grow much into the future, but electric cars are just starting their inflection point right now. And so electric cars are basically where smartphones were, 15 years ago. And if you don't believe that transition's happening right now, I'm actually going to go forward and back here, actually. This is just a good slide that shows the shift that you can see very much happening in China, where 30%, in Europe is the top bar there. 30% of every car that was sold in December 2021 was an electric car or plug-in hybrid electric vehicle. Over 15% of every car sold in China in December was an electric car or a plug-in electric vehicle. And here you can see the US is still sub 5%, and Australia is unfortunately still sub 5% as well. But as you can see, there's a clear inflection occurring here. And the inflection is occurring mainly because we're actually finally getting these vehicles coming to market. So previously, if you wanted to buy an electric car, you could only buy a Tesla. Now, other companies are getting to the market with cars. And so if anything, this would be going faster if more cars were available. The big exciting opportunity for us here is obviously, you could look at the Teslas and stuff of the world, and we do like them. But the biggest and easier opportunity for us is in semiconductors. Ultimately an electric car is driven mainly by these things called power semiconductors. Power semiconductors are the muscle in a muscle car. Effectively, you have to take a battery and turn it into torque rather than internal combustion engine turned it into torque. And so you need a lot of semiconductors. And so these quite boring semiconductors that used to, just drive toys and remote control cars now have to drive a real car. And so from that point of view, you get this huge uplift in semi content per car. On the right here, we're showing you what will happen, from roughly $400 a car, we think, to over $1,000 a car by 2030 of semiconductor content. And this happens regardless of whether you sell more cars or not. If you just sell 90 million cars per annum, this will happen. So this is a classic structural shift. It's a classic S-curve opportunity. And so from that point of view, the company we like here that we've spoken about before is On Semiconductor. We'd also point to an Infineon in Germany. The reality is they make these things called power semis. Power semis are going to have to go into every electric vehicle, every charging point, every renewable energy infrastructure. Everything where you have to electrify the economy, you're going to need more power semis. And power semis are run by these companies where they previously used to be quite a boring product, mainly used in industrials and other areas. And so from that point of view, this is On Semi. You can see this is their earnings along the bottom here. You can see the inflection in electric cars starting to happen. So these are the upgrades that have happened to earnings in the last year or so. We fully expect these upgrades to continue regardless of what happens to the economy. And from that point of view, you're roughly paying, well, you're paying even lower than this now. You're paying roughly 13 times earnings for the company. And so the EPS keeps going up. The multiple can't derate forever. Eventually, the market will recognize the strength in this story. And you can see it already has in the last year. And we think that will continue into the future. We'd say it's exactly the same for Infineon, and we'd say it's exactly the same for other parts of this electric car supply chain. Yes, there'll be bumps along the way, but the trend is clearly there. We have the template from previously, and we think that template will continue for electric cars. And so what I'm going to do here is I'm just going to stop and maybe throw it open for Q&A. I suppose just to summarize really quickly what I said, ultimately we're here to talk about the climate product, the one that enables the decarbonisation of the planet. There are 15 to 25 ideas in the fund. James showed you how we've diversified it within the different opportunities. So there isn't any one single opportunity or one single rule change that's going to affect the fund. And ultimately, we think the tailwinds are there for this to play out for earnings growth for all of these companies over a very long period of time. Our job from here is that clearly we'll make some mistakes and we'll have to eradicate them. But our job from here is to continue to position the product towards the enablers of the decarbonisation of the planet. And then assuming we do try to decarbonise the planet, which I think is effectively a done deal from here, then these companies will hopefully benefit from that, which ultimately lead to earnings growth, which lead to share price growth, which will give performance of the product. And so that's a short summary of how we set the fund up, what it does, and we're now available for your questions.
Excellent. Thanks very much, Nick and James. So the first question I might actually throw to Mike. So Mike, I'll welcome you to the call. And it's in relation to the recent AGL bid from Mike Cannon-Brooks and Brookfield. I'm keen to get your views on this, but maybe before you answer that, maybe now's a good time to, if you could provide some feedback, first of all, on how Munro integrate ESG into the investment process.
Yeah, thanks, Steve. And Nick, if you could just go to, I think it's slide 40, please. So, I mean, I know we're talking about the climate fund today, but how we integrate ESG is essentially the same for all the funds. And so I think both James and Nick talked about, the 5 characteristics which determine ultimately the multiple that we're willing to pay for a company and then determine the price target. So currently, ESG is embedded in that, which means that we're willing to pay more for a company that performs better on ESG or environmental, social, and governance factors. And then just to sort of outline briefly some of the broader considerations around ESG, Nick, if you just go to the next slide. So we really think about ESG in terms of 2 main pillars about how it impacts our investments, which are the 2 there on the left-hand side. And then the third is, how we actually run Munro Partners itself as a business. We have these issues impact us as an operation as well. So I'll just touch on 2 aspects of the ESG integration piece first. So first is this ESG score. So really, in the same way that we have to date integrated ESG into the multiple, we will continue to do that. But the way that we do that, I think, will become much more in-depth and detailed over time. So we've recently signed on to the SASB framework, which essentially gives us a really great starting point to understand, what are the material ESG issues for each type of company in our portfolio. They're definitely not all the same. And so for us to actually get a stronger view, we need to actually go into the individual issues and work through those directly. So it gives us a more rounded view of each company. So we'll be more alert to the ESG signals that inevitably emerge in these companies. And we can also, also it acts as a prompt, I suppose, for us to build that into other parts of our thinking, other parts of our modeling in terms of earnings forecasts and so forth. The other thing which I'll just touch on is at the bottom left of that screen, which is around exclusions or negative screens. So we've recently agreed to implement some formal, I suppose, exclusions within the within all of our portfolios. So within all of our portfolios, we will exclude tobacco, controversial weapons. We will obviously implement sanctions as well, that are obviously key topic at the moment, as well as companies that actually perform very poorly on ESG. So to be clear, none of these are currently in the portfolio, in any of our portfolios, but we're setting a sort of a rule around that. Within the Climate Change Leaders Fund, beyond that, in addition to that, obviously, things like tar sands, thermal coal mining won't be in at all. We'll also restrict and I guess put a bar around oil and gas and fossil fuel-based generation, subject to some limits. I think we do, and we will have some exposure, especially to the fossil fuel-based generation, but only if there are very clear targets around decarbonisation and sort of transitioning. The second pillar I'll just briefly touch on before getting to your question finally about AGL is just around stewardship. So I think, and certainly it's been a big part of my sort of 10 years in ESG is actually not just deciding which companies to invest in, using ESG to do that, but also once you have invested, actually using the voice and the power that gives you to make a positive contribution. So just before this, we just got off a phone call with a very large, I'm sure very well-known company, and we were asking questions around ESG. So we want to be, we're doing that today, and over time, I think once we have a really firm view around what specific expectations we have of each portfolio company, we want to do that in a much more kind of proactive way going forward. But it's certainly something that's already happening. Maybe just briefly, just to I guess, give my 2 cents from an ESG perspective about the Climate Change Leaders Fund. I suppose, first of all, there's been a lot of investor focus, including in Australia, I know, around the companies that are the high transition risk companies. So those, fossil fuel-based generators, industrials, and miners that, make a large negative contribution to climate change. So I think that's really important. But I think what differentiates this fund and what's really exciting about it is it's looking at the other side of that opportunity. Investors need to act to reduce, to do their role, I suppose, in the companies that they invest in. But they should also be, I guess, backing the companies that will actually enable that decarbonisation too. So that's really exciting for me. To your question around AGL, I mean, it's not a company that we invest in and therefore, look as closely at. But I think going back to that theme that Nick was talking about, it really is a case study that government policy is not the only driver of the transition. So it's in this case investors and to a certain degree the companies themselves that are driving this transition. So clearly, obviously, Grok Ventures has ambitions and motivations around the environment and climate goals, but actually so does Brookfield. So they're a leading investor in renewables. I know they've got net zero commitments themselves. Just like many other investors, they've got Mark Carney on their board, and he was one of the kind of architects of the TCFD framework, which everybody uses. If you look at AGL themselves, last year, 50% of their shareholders, more than 50% of their shareholders, voted for them to set tougher Paris-aligned targets. I guess going to some of the companies within our portfolio, I suppose there's a big re-rating potential for companies, especially these sort of historically fossil fuel-based utilities, to transitioning. So some of the analysis that I've seen suggests that, in Europe, fossil fuel-based utilities trade at nearly a 50% discount to more renewables-based utilities. And so that's the opportunity, I suppose, for those fossil fuel-based utilities. And for us, there are companies in our portfolio such as RWE and in Germany, and American Electric Power in the United States, obviously, that are going through this transition. And so AEP, for example, we estimate that they're going to reduce their emissions profile by at least 50% and be more than 50% carbon free within the next 5 years. RWE has similar sort of targets out to 2030, and it could potentially move much faster in their case as well. So there are definitely opportunities there to invest in these sort of transitioning companies, and not only invest in them, but actually use that stewardship component to actually nudge them along and really, use your voice as a shareholder to push them to make even firmer commitments as well.
Okay, excellent. Thanks, Mike. Just as a follow-up question on transition and the pace of the world's energy transition, if we shut off conventional sources of energy, transport, etc., too soon, there is potential for all sorts of disruption in energy prices, job losses, etc. As a result, some say there is a risk that the social mandate for energy transition could be lost. What would you say about that? I'm not too sure who would like to take that question.
Yeah, I'll start, and maybe the other guys can chip in. Look, clearly it is going to be a transition. It's going to be a volatile transition. And if you thought it was going to be volatile before, Russia just invaded Ukraine, it's going to get even more volatile. It's important to stress that that everything that pushes energy prices higher just actually accelerates the transition. So if anything, if you're Germany right now, and I'm sure James will talk about this in a second, you're accelerating your shift to renewable energy, because you don't really have a choice because of what's happened with Russia. And you knew this was a problem before, and now that problem's come to bear. The second thing I'd say, at the corporate level, the company we just got off the phone to was Chevron. It's the second largest oil company in the world. And 61% of its shareholder wants it to do more to decarbonize. And so importantly, even if we need more oil, it's going to be very hard to convince these companies to go look for it. Why are they not going to look for it? Because they know that ultimately, it's a sunset industry. Maybe it's 10 years, maybe it's 20 years away, but ultimately they will. And so these volatility around prices is going to continue. The transition is not going to be smooth. It's not a simple handoff. It never is. But it's important to stress that, we have reached that tipping point in corporates basically committing to decarbonisation. Even oil companies are doing it. I don't think that's going to change, particularly when you look at what the superannuation companies in Australia are starting to talk about doing, et cetera, and running climate neutral investment portfolios. Management's got the message. It's indoctrinated into CEOs' pay packages now. And so I just can't see this changing. And if anything, the volatility that creates actually accelerates the transition because you just move faster to electricity, you move faster to electric cars. And so the last thing I'd just say really quickly on this, this slide I think is telling. It's a monumental task. This is the share of energy consumption, like i.e. cars run on petrol, your home runs on electricity, your heating runs on gas. You have to move it all to electricity. It's a monumental task. It's not going to be smooth, but anything that creates volatility just makes you do it faster, in our opinion.
Okay, thanks, Nick. James, you touched on valuations when discussing the investments in the fund by subtrend. How much growth do you think is currently priced in?
Sorry, guys, I lost you and I'm back on another computer. Apologies.
No, that's okay. I'll just repeat the question. So you touched on valuations, James, when you're discussing investments by subtrend. How much of the growth do you think is currently priced in with these climate stocks?
Yep. Thanks for the question. Interesting. So valuations are obviously moving a long way. There was probably a pretty significant bid up in the EV side in particular, sort of last year. And so we're probably quite cognizant of that and not getting over our skis in terms of paying up too much for
for growth there. So we basically wanted companies as we launched this fund that were strongly profitable, trading at reasonable valuation multiples, and had decent market cap behind them as well, because we did foresee some of the difficulties in the markets today as it relates to the Fed. Obviously, we didn't know about the Russia-Ukraine situation at the time, but we knew that in a sort of rising rate environment, valuations would come under more pressure. And so that's why we did rotate the portfolio back toward some of the areas that we're showing here. So the sort of more circular economy names that are still, very good climate related opportunities, have very good tailwinds for growth, structural tailwinds for growth, as well as the clean energy names as well, which again traded at sort of the lower multiples. Mike sort of mentioned companies going through re-ratings as well as they transitioned from sort of traditional fossil fuels to more renewables-based businesses, and obviously picking up that re-rating as well. So they tended to be cheap, and we're hoping for that re-rating. We talked about NextEra, trades at sort of high teens EV to EBITDA. One of the companies Mike mentioned trades at a much lower than that EV to EBITDA, about half of that. And we don't expect it to fully re-rate to NextEra's multiple, but there is an opportunity for these other companies like RWE to sort of trade up relative to NextEra, which is already there, already has a really strong premium for its high quality operations and its high quality ESG position, whereas others like RWE, American Electric Power, etc., we're hoping get there, and that's part of the stewardship that Mike's talking about, that we'll try to prod the company to get there. So hopefully I caught most of your question there, Steve.
I might jump in on the last bit.
Sorry about that.
And just so to be clear, across the portfolio trades basically in line with the market multiple today. There are no companies that are not profitable in the fund today. They're all profitable. And in many scenarios, when we look at the opportunity, we generally find, and this is again why we're so excited about it, we generally find companies that trade at or below the market multiple that have this huge structural tailwind in front of them that the market has effectively missed. And I suppose I just go back to what we said right at the start. When we first bought Apple in 2009, it traded at 15 times earnings, and everyone thought it was a device company. When we're buying, Saint-Gobain or Schneider Electric today, people think they're building materials companies or electrical equipment companies or air conditioning companies, and they trade at roughly the market multiple, yet they have this huge structural tailwind behind them now. And this is the opportunity that is in climate. It's as much in companies that are what would normally be seen as for boring industrial companies, as it is in these new technology companies, these exciting companies that are coming along, and the fund will generally have a mix of them.
Okay, thank you. Can you comment on the recent surge in the nickel price and the impact on automakers' EV ambitions? Yeah,
so look, the nickel thing is interesting, to put it mildly. From our point of view, the stats we've seen at the moment is it equals roughly a 20 to 25% increase in battery costs, which basically equals a 3% increase in the price of your car. It is becoming clear that potentially there has been, some producers that are caught offside. It's also clear that the Russians might not be able to supply as much as they used to. Arguably, that product still gets out to China, but ultimately, it's definitely a bump in the road, but it doesn't kill the story because it's a 3% rise in the price of your car. Most electric vehicles at the moment are sold to affluent consumers. That's definitely going to continue in the short term. Outside of China, in China, it's sold to the broad community. And so ultimately, we don't think it affects the transition at this point in time. But clearly, there is opportunity, by the way, on the resource side, because the scarcity that was already apparent before the Russia invasion is now significantly worse. And so we're definitely looking more closely at that side of things.
Okay. How many stocks do you have in your climate universe that you're looking at? And could you get exposure to the climate thematic through carbon credits?
Do you want to take the first part, James? I'll take the second.
Yeah, there's about 120 odd companies in the climate universe. It's been sort of built up. There's no sort of MSCI, screen or sector categorization that you can sort of download off the internet. You've got to sort of build it yourself. So, yeah, it's about 100 or 120 or so stocks that we've identified over time, and maybe Nick's slide 12. They're generally sort of fitting into these type of categories here. So yeah, we've met companies over time and spoken to them, and some have been, you know, traditional businesses that haven't sort of fit into the opportunity, and then over time, you know, you've identified an opportunity, you know, that's climate related, and we basically feel like climate's going to touch pretty much every company out there, but there's probably 100 or so that we've identified as being key enablers. To sort of get into the universe, what we're saying is that you need to have 50% plus of your revenues contributing to, I suppose, climate solutions within 5 years. And that's obviously a forecast. So there are companies today that are, as we talked about transitioning, so we talked about the utilities of transitioning. There's companies involved in sort of industrial gases and so forth that are transitioning and potentially going to be leaders in green hydrogen, for example, into the future. And so they're not doing that today because that's not a viable technology today, or it's not a widespread technology today. But within 5 years, we can forecast that they're going to get to above that 50% mark, and so therefore that opportunity would classify as a climate opportunity within our definition of the universe. So that's how we sort of think about that.
And look, on carbon credits quickly. Look, I've been investing in carbon credits since 2005. Or at least looking at them. There are no carbon credits in the fund today. It's important to stress that these things are highly leveraged to the economy. They're leveraged to the economy because you hand them out for free and then you slowly reduce the amount. What generally happens is people buy them early and store them, forecasting the price to go up. And then if the economy goes down, they realize that they don't need them anymore and they sell them. So the European carbon price has been around since 2005. It's actually gone to zero twice in that time horizon, and they've reset it. They're definitely doing a much better job of it now. But from our point of view, we'd rather buy the companies like RWE, etc., that benefit from the higher carbon price, i.e. they're a renewable generator. The carbon price pushes up electricity, which ultimately makes them more profitable. And so at this stage, we're not investing in carbon, and we just warn people it's not as simple as it looks. The last thing we just said about the carbon price, that if you are successful in decarbonising the planet, then the carbon price should ultimately go to zero. That's the goal. And so just recognize it is a little bit more complicated than it looks. And right now, we'd rather just buy management teams that we know are helping solve this problem. That's what we've been doing for 15 years, and the management teams can solve this problem, will ultimately navigate their way through this.
Okay. Nick, the fund has a low allocation to tech companies. With the sell-off in tech, are there any clean tech companies that Munro believes currently look attractive, or any on your watch list if the market continues to fall further?
Yeah, so the ones we like at the moment we've discussed are the semiconductor companies. So they are in the tech sector, but they're leveraged mainly to industrials and autos. The other stuff that we would look at that has sold off a lot would be solar, and charging infrastructure is something that we've added a little bit more recently, and some of those sit in the tech sector. Those would be the main ones I'd flag. James, can you, think of any others that we're looking at closely?
Not tech per se, given most tech is sort of like software or internet or something like that, and it doesn't really decarbonize the planet. I suppose the one thing we'd love to have is something along the sort of data information side of things over time. Like obviously, as the world goes to net zero, these companies are going to have to report how they're progressing, and someone's going to need to capture all this data and so forth. So it'd be great to be able to find a company involved in that, but there's no real pure play there. And obviously all this is going to need to be audited, as Nick mentioned. The BHP situation, audited by EY. There's going to be an opportunity for, I'm sure, some sort of data related company, but we haven't quite found it yet, although we are looking.
Okay, thanks. How are your geopolitical risks factoring into your semiconductor investments? And do you believe Australia could have a greater role in the semiconductor industry? How so, and do you have any local investments in this space?
Okay, so on the geopolitics, obviously this is a China-Taiwan thing. The power semi companies, for instance, actually make it themselves. So it's one of the few semiconductors that's not made in Taiwan. So those companies have their own facilities in places like United States, Germany, Mexico, etc. So they're somewhat immunized from it. it's important to stress, I saw there's a question in there about NVIDIA. NVIDIA is a great company and we like it a lot, but it's not a decarbonizer of the planet, so to speak. And, in the same way that Microsoft is a great ESG company and we like it a lot, but it's not enabling the decarbonisation of the planet. So neither of those are in the fund today. Can Australia play a bigger role in the semiconductor industry? The answer is no. They are no chance. You cannot catch up. That's the beauty of semis. Semis is all about shrink. Those in front win. Everyone who tries to catch up, the guys in front keep getting further in front. So that's Taiwan and South Korea on the foundry side. The best way Australia can get involved, and this is the way to think about it, is from the IP side. And so NVIDIA, which we think is the greatest semiconductor company in the world today, or AMD, they don't actually make any of their own semiconductors. They're all IP companies. The manufacturing gets done at foundries. And so there are, I think, a couple of very good IP semiconductor companies in Australia, but I'll let you go find them yourself if that's okay. I haven't looked at them for a little while, I'll be honest, but there are a couple of good little ones around.
If we might talk more about, just in the last few minutes, just more about the characteristics of the portfolio. So a couple of questions here. Can you please discuss the risk management parameters around funds, stocks, sector, country, stop losses? Do you just want to talk a bit about that?
Yeah, so there's very little country and sector limits. They do exist, but they're sort of in the 50 to 60% range. And I'll let you find those in the documents. The biggest one we have is a maximum position size is 10%. So these are the same as they are for our main funds, 15 to 25 positions. We set price targets on a 5-year and 12-month basis. We do run the same stop loss process. So the same stop loss process, if any company falls 20% from peak or from cost, it's subject to a review. We are at the start of this process, so we are going to make mistakes. You could have thought smartphones are the greatest things in the world back in 2008, and you could still be here today owning your BlackBerry shares going, you missed it by that much. The reality is we're going to make mistakes. You're going to be looking in the right areas, but you're going to make mistakes. And so the stop loss protocols are going to be required. And so if these companies do fall 20% from peak, we have to review and decide, is the investment case still valid? In many cases, we decide to keep the company, but in other times we will review it and realize that there's a problem, or that maybe a Chinese competitor's gone past them, et cetera, et cetera. This happens all the time in our main funds, and it's going to happen all the time in the climate fund. But your goal is to get to the picture we have on the right. And this is showing you for the main fund, those are the top 10 winners since inception in basis points contribution to the fund, and the top 10 losers through inception. We don't have this data for climate yet, because obviously, we've been running it virtual for 12 months and properly for about 7 months. But the reality is your job, as it always is in investing, is to find those few winners and run them for long periods of time, and to eradicate those losers. And so our view is if you keep looking in these areas of structural growth, you will find those tailwinds. Those tailwinds will equal earnings growth, and those earnings growth will equal share price growth. And provided you're disciplined about eradicating your mistakes from the companies that aren't going to execute on the opportunity along the way, you can get the picture to look like this. And that ultimately is going to drive you to the double-digit returns that we achieve for our clients.
Okay, and just in terms of crossover between the climate fund and the global growth fund?
Yeah, so I'll take that quickly. So obviously the Global Growth Fund today has roughly 10% of its investments in climate, maybe a little bit less than that, and across 7 names. The Climate Fund has another 13 names in it, I think to 20 today, and there are 13 next best ideas. Doesn't mean they're worse than the 7 that are in the Global Fund, but it just means it's a pure play, diversified portfolio that is trying to capture this opportunity. The Munro Global Growth Fund and the main funds, I'm sure, will continue to invest in climate and more like a sort of a 10 to 15% exposure. We can't actually go over 20% under our internal rules. And we still love this opportunity over a very long period of time, but it'll move up and down. The climate fund will always be fully invested in companies that enable the decarbonisation of the planet.
Okay, Nick, we might wrap up. So I might just hand over to you. Is there any final comments you'd like to make before we do wrap the call up?
Yeah, so the one thing I just wanted to stress to people listening to the call is obviously there's a lot of ESG products out there and a lot of climate-related products out there. Our product is very much an actively managed product that's focused on carbon solutions. So every company we're investing in is a management team effectively trying to solve a problem which is they're providing a product that help enable the decarbonisation of the planet. These are some of the funds investments on the right, and some of the things that their products do. And even Sustainalytics says our portfolio is 61% indexed to climate solutions. We actually think it's 100%. The last thing I'd just say is don't think this is mutually exclusive to making money. In the end, in the 20 years I've been doing this job, how you make money is you find great management teams that are trying to solve big problems. Sometimes you don't even know the problem exists. So sometimes you didn't realize the internet needed to be on your telephone, but in the end, it was really helpful and it created the biggest company in the world. This is just a great slide showing Tesla. Tesla has effectively tried to solve a problem, which is to accelerate the development of electric cars. Cumulatively, they needed to raise nearly $18 billion in capital from investors over that time horizon to help accelerate their plan and to basically wrong foot the auto industry. And what that ultimately did was the people who gave them that capital were incredibly successful in share price returns. The management team was incredibly successful in share price returns. And the world, quite frankly, is a better place for the fact that they managed to solve this problem quicker. What we're saying here is money allocated to this product will be allocated to those companies that enable the solutions, the management teams that we think can do obviously what Tesla has already done. And anybody who can help bring this forward is obviously solving a problem the world needs, and they should be successful. And that's where we're going to allocate the capital. And my point is don't think that this is mutually exclusive to making money. We think it is a very good opportunity and a very good place to allocate your capital. And that's why we're so excited about the fund. Yes, there's going to be bumps and twists and turns along the road. We're probably in one of those bumps right now. But I'm personally super looking forward to the next 5 to 10 years of doing these sorts of webinars, talking about how this opportunity evolves and as it becomes bigger and bigger in the months and years ahead. And so we thank you very much for your attention.
Terrific. Well, Nick, James and Mike, thanks very much for sharing your views today. As you said, Nick, it is a pretty complicated world right now, and we look forward to the next update in due course. Ladies and gentlemen, thank you for dialing in today, and I hope you enjoyed the discussion. Today, Munro has 3 offerings. We have the flagship absolute return offering, the Munro Global Growth Fund. We have a concentrated version of the flagship in a long-only format, which is the Munro Concentrated Global Growth Fund. And as you've heard today, the newest offering being the Munro Climate Change Leaders Fund. All 3 funds are available as unlisted funds via platforms and also direct. And in addition, they're also now available via the ASX. The ticker for the Climate Change Leader Fund is MCCL, and it's starting to make its way onto platforms also. If you would like to see it added to your preferred platform, please let us know. We'll work with you closely and your platform provider to make this happen. But once again, on behalf of GSFM and Munro Partners, thanks for your interest in the Munro Climate Change Leaders Fund. We look forward to speaking with you all very soon, and please enjoy the rest of your day. Thank you.
Thanks very much.
Thanks very much.